You're watching Rogers TV.
Hello, everyone, and welcome to Money Matters with Shannon Jackson, the personal finance show focused on moving you forward financially. On today's show, we're talking about the new mortgage rules recently announced. What will the changes mean for first-time buyers or for those who are looking to renew their mortgage? And what about the housing market itself? Will the changes help or harm the housing market nationally or especially here at home in Simcoe County? So joining me now to answer those questions and share his advice is Cory Kline, mortgage agent with Neighbourhood Dominion Lending Centres. Cory, thank you so much for being here.
Hey, Shannon, thanks for having me on the show today.
Yeah, of course. Before we get into our discussion, can you just share a little bit about yourself and especially about your business and the work that you do?
Yeah, thank you. Yeah, so as you mentioned, I'm a mortgage agent with Neighbourhood Dominion Lending Centres. I deal in both bank mortgages, alternate mortgages, private mortgages, reverse mortgages. So there's a lot of different options that we can bring to the table to help people put together their plans. I've been doing this since 1998 when I was 19 years old. So mortgages is really all that I know. And I was drawn to mortgages because I felt it's an area where you can really impact families. Excuse me, the decisions that people make on their mortgage and with their house has a huge impact on the outcome of their life. And I really try to steer people towards a clear and fulfilling and purposeful life.
Well, you're definitely the right person to be talking to today about these changes and the new mortgage rules that have been implemented. So the federal government is calling them the boldest mortgage reforms in decades. And they add that it will unlock home ownership for more Canadians. So Cory, what is your initial response to the comments from the government?
Yeah, these are rules that I've been waiting to hear for a long time. What I'd like to do is I sent through a chart, and so if we could bring that up, and I just want to start by saying this is a unofficial chart. This is from my own history, my own memoirs, as well as my unofficial research, and I just wanted to share with the viewers an oversight of where insured mortgages rules have changed, where they've gotten easier, where they've gotten harder, kind of how we've gotten to this point. And so that a viewer can take a look and make their own educated decision as to what they think is going to happen in the future. So starting on the left side of the screen, you can see that in 1990, CMHC was just talking about the idea of reducing the minimum down payment from 10% to 5%. And 3 years later, in 1993, it became a reality for first-time buyers to be able to buy a house with 5% down. 5 years later, in 1998, it became a reality for all Canadians to be able to apply for a mortgage, to put 5% down, even if they'd owned a home before or if they currently own a home. And everything stayed pretty stable with mortgage rules, especially in the insurance, like the CMHC space, for 6-7 years till 2005, 2006 range. And this is where we started to see a lot of changes come quickly in the mortgage insurance space. We went from 25 years to 30 years to 35 year to 40-year amortizations. We went from the 5% minimum down payment to people were getting financed with zero down and getting 100% financing. And also at that time, so this was into 2007, we were doing refinances up to 95% of the value of the house. And we were able to help many families consolidate their debt and bring it down into one lower payment. And in this time period, it was these solutions, particularly the first two, were touted as a solution to be able to buy your second home first and be able to avoid buying the starter home and just be able to go right from when you're purchasing your first home, be able to buy more of a longer term home, which really resonated well with Canadians. And a lot of people were able to get into a home that they could stay in for quite a while. What happened though, in 2008, we ran into the global financial crisis, and it started to, even though the Canadian mortgage market and the Canadian housing market was very strong, what we were seeing in the United States, there was a lot of foreclosures from banks on people's homes, and there was a lot of worry about, I think, the perception of, the Wild West of lending. And so we started seeing a regression in all these rules. So we went from a 40-year to a 35-year to a 30-year to a 25-year amortization. Refinances went from 95% to 90, 85% to non-existent in the CMHC world. We got a stress test added on. We had a cap of CMHC would only be involved if properties were worth $1 million or less, targeting, trying to help more the first-time home buyer than every Canadian, trying to share some of that risk with the bank, I believe. So there was a long period of tightening. And although it didn't feel good in that time period, what happened here is, outside of interest rates, the government was able to kind of pull back or put a pause on these different opportunities to make things easier for Canadians, so that I believe they could re-unleash them when the time became right. And so this all hit the tightening hit a end, I think, in 2020. CMHC temporarily did a minimum, the minimum credit score was bumped up a little bit higher. Affordability restrictions were made a little bit higher. But then the next year, in 2021, these rules were reversed. And that was a signal to me that we were going to start going in the other direction. Now, I've been patiently waiting a couple of years, but they're finally coming through this year. And I do think they are, some of the most welcomed and drastic changes that we have seen, really going even back to 1990-93, where we went down to 5% down and then 5% down for everybody in 98. So yes.
So there is going to be lots of changes coming, and it sounds like they're sort of going to be implemented towards the end of this year. And one of them, I believe, is that the cap, or the price point cap, for the value of the home for someone who doesn't have a 20% down payment, they can get an insured mortgage up to a value of the home of it used to be 1 million, now it's 1.5 million. Is that right?
That's correct. That's one of the big changes that are coming our way, for sure.
Do you think that particular change is going to be something that's beneficial? Because from my side, I'm just a little concerned that people are going to be maybe taking on a little more debt than perhaps they can handle, and they might end up being maybe in that house poor kind of situation.
I think there's a lot of safeguards put in place. So I think, although we're opening things up from a $1 million price point to a 1.5 million, I think we're going to have, people are already kind of at their max at $1 million if they're buying on their own. What I think we're going to start seeing, if people are going to move into the 1 to 1.5 million, is multi-generational homes. So instead of just having maybe one couple in the house, I think we're going to see people that are buying into the 1.5 range are actually two different families, either siblings buying together or people buying with their parents or their children. And then all of a sudden you've got 4 incomes potentially in that household. And you're making it actually much more affordable for 4 people to run a $1.5 million house than for, let's say 2 people to run a $900,000 house.
That's interesting, because you don't think often about how home ownership is not necessarily a single family ownership type of situation, especially in our current Canadian culture. And so that's a good point, that it could be a generational thing that might be happening with these larger price points and things like that. Now, what about the longer amortization period up to that 30 years? What are your feelings about that?
Yeah, I think it's very welcomed as well, and it has to be managed properly. But here's how this came through. So in April, we got an announcement that in August, first-time buyers will be able to build a qualifying new house and be able to get a 30-year amortization and qualify with a 30-year amortization. And so that came out just last month, or no, sorry, in August. It was released. Last month, it was announced that come December, that we're going to have first-time buyers be able to purchase any house and get a 30-year amortization. And you're also going to be able to not be a first-time home buyer and purchase a brand new built house and also look at a 30-year amortization. So I think what happened there is they made the first, and this is what happens if you recall from the graph, it happens in waves. So I think these are just steps in the waves towards loosening and making things easier for Canadians to be able to afford their home and to be able to buy a home. But so these changes they'll definitely help. The trick with a 30-year mortgage is it doesn't have to stay a 30-year mortgage while you're in it. So you get in now and you afford the 30-year payment, that's great. As your life gets bigger and better and you have more income or less obligations, you can start making extra payments on that mortgage. So even if you take a 30-year mortgage, the 30-year mortgages I set clients up with, almost all of them could be paid off in 4.5 years without a mortgage penalty. Like they're that flexible to be able to make extra payments every week if you wish.
Well, and that's good advice too. Now, of course, one of the goals of the federal government with these changes is they're hoping that it's going to spark new construction and also sort of increase those housing opportunities for all Canadians, especially here in Ontario. Do you think that these changes will encourage that?
Yeah, I do. I think these changes, along with CMHC, is another program called MLI Select, which is around 5 plexes or more. But I do think what we're going to see is a lot of families coming in, buying together. They're going to sell 2 houses, purchase one from a builder of a home that is purposely made for multi-generational. I'm seeing a lot of advertisements, especially from Toronto, of even townhouses that are built to really accommodate 2 families quite well. And so I think what we're going to build is going to be different. I think it's a really good change that's coming, and it's something where it's a change that we might not love at beginning, but I think it's going to create something that's going to have much more healthy financial lifestyles for Canadians in general. The other thing that I see exploding is the what they call them, pre-engineered homes or prefabricated homes. Sometimes people call them a modular home. The uniqueness of what's happening in that industry. I mean, they used to be something that people would shy away from, and now they're understanding you can build one of these homes inside, have it delivered quicker than you could build it yourself. And some of these homes are just way more beautiful than what a standard home would even look like.
We've only got a couple minutes, and I just want to touch a little bit on the interest rates and how the Bank of Canada we've had a couple interest rates decrease or cuts since June, and economists are expecting that there could be a few more cuts before the end of this year, up to perhaps a full percentage point. And so what are these decreasing interest rates? How is that going to affect homeowners right now?
I think for existing homeowners, this is huge. We have an unbelievable amount of renewals coming up over the next 2 years in Canada. Most people's mortgages, in fact, are coming up for renewal in the next 2 years. So this reduction in interest rates, particularly on the variable side, I think that's really going to help people be able to navigate through that. But maybe we'll talk about it after the break, but there's so much more the families need to be doing right now and next year.
Well, we're going to get into all of that because Cory's already given some really great information, and there's going to be more coming up after the break when Money Matters returns.
This program is brought to you by Ignite TV. Now you're in command. Visit Rogers.com for more details.
I'm Wendell Clark with a word about winning. We all know it takes a team effort in any sport and with any challenge. You can be a part of the winning team that shuts out impaired driving. Whether you're out on the town or just hanging out with friends, drink responsibly. Always have a plan for a safe ride home for yourself, your family, and your friends. You'll be helping to shut out impaired driving.
Visit ArriveAlive.org to find out more. Arrive Alive. Drive sober.
Public transit, garbage pickup, parks and recreation programs, snow removal on your street. How can you stay informed about these and other important local services? Tune to City Council coverage on Rogers TV. See your community leaders at work on Rogers TV City Council coverage.
Welcome back to Money Matters with Shannon Jackson. My guest today is Cory Kline, mortgage agent with Neighbourhood Dominion Lending Centres. And as you've been listening to, the federal government has announced the boldest mortgage reforms in decades. And the aim is to make home ownership more affordable for Canadians. The changes will certainly prove beneficial for homeowners and potential homeowners, and perhaps the real estate market as a whole. And of course, as you heard before the break, the lower interest rates are going to help. Rates are on a downward trend right now, which is of course good news. And we have had several rate reductions since June of this year, and we are expecting more towards the end of December of 2024. So Cory, you were talking about how these interest rate decreases have been a benefit. But I think it's important to point out that those homeowners that are facing a renewal in the next year or so, I think they're still going to come up with a bit of a financial shock. I think their payment is still going to increase because the rates really haven't gone down to what they were over 4 years ago. So can you maybe walk us through an example about what a current mortgage renewal might look like?
Yeah, absolutely. So, we have a lot of people that they're sitting there right now with like 1.9% interest rates or 2.25%. It's fabulous while you have it. But we kind of get accustomed to the lifestyle based on our mortgage being so low, based on that low interest rate. So I know this is on the mind of a lot of families that they're calling me, they're concerned. I mean, I have people, their mortgage isn't coming up till 2026, and they're calling me because they're concerned. They want to know what do they do? Because, I mean, generally we're seeing renewal payments can go up $700, $800, $1,000 or more a month, just from 1 month to the next. So if you're going from 1.9 to a new fixed rate, maybe in the 4% range, that's a hefty jump. That's maybe double the interest that you were paying previously. Now, the good news is that if we would have been looking at this maybe about a year ago, you would have been looking at going from 1.9 to maybe 6.25. So these fixed rates have came down a lot. And generally speaking, fixed rates will come down before variable rate. It's important to note that they're not tied to each other. So a variable rate is kind of governed by the Bank of Canada. The Bank of Canada sets the overnight rate. It usually gets passed down to the banks in the form of a prime rate to their clients, and then their variable rate mortgage will go up or down with that. So when the Bank of Canada makes a shift, the variable rate mortgage will shift. But with a fixed rate mortgage, it's more so based off the stock market, really the bond market is where these funds come from. And then the stock market kind of indicates where the bond market goes. And it's really consumer confidence that drives the stock market and speculation. So what happens is when we're seeing, a lot of people are anticipating a 0.5% drop in prime later this month. And as you said, 1% by the end of this year. And I was looking at a report that I had snipped out over a year ago where TD was suggesting we'd be down to a 2.25% overnight rate by the end of next year, which would be another percentage point throughout next year. And it could be more, it could be less. But in any event, the fixed rates dropping from 6 to 4, they've already priced a lot of that in. That's their expectation. And so that's why the fixed rates have already happened. The other part is that there's an inverted bond yield because we've been worried about a recession. And so right now, it's been for the last year or two, it's been odd that a 5-year fixed is much lower than a 2 or 1 year mortgage or a variable rate mortgage. It's completely backwards to normal. And I think what we're going to see is that 1 and 2 year is going to swing back under the 5-year rate. The variable will drop aggressively and go under the 5-year rate. And the 5-year, I think it's, in and around the area where it will land. all things being equal. So there's a lot of discussion to have when you're picking between a variable rate or a fixed rate and what your plan is for that. And so nothing's really changed to the last 25 years of doing this, where you really have to sit down, have a conversation, say, well, these are my goals, and is the variable rate right for me? Because it may or may not be, especially being that it's going to be right now a higher rate than going into a 5-year in the first place.
Well, that's pretty interesting because you sort of touched on the idea of sorting out what your goals are moving forward. And so what is your advice for somebody who might be looking to maybe shop around for the best rate? What should somebody be doing right now?
Yeah, talk to everybody you can. Talk to your friends, talk to your bank, talk to your broker, just get information. Go online, but be careful online because you don't seem to get the whole picture of the interest rate. Secondly, I'd say that put rate second. The primary thing should be your goals. So when I sit down with a client, what we do is at first we go through different areas of their life and we prioritize their goals so that we get a clear understanding of where they want to go. We take a look at their budget so that myself and them have a clear understanding of where they are financially, what direction they're headed, and what changes that they need to make. Then we compare the different options. So we will take a look at refinancing or second mortgage or a line of credit or selling and buying, or should you consider a consumer proposal? We take a look at all these ideas, and then the client says, okay, yeah, I really think a refinance is best for me. And I'll tell you, I have lots of clients right now, even though the mortgage comes up for renewal next year or 2026, and they're at 1.9%. And they're not hesitating to break out of that mortgage to create a plan that's going to get them towards where they're going quicker. Even though they're going to pay a penalty and get out of 1.9, they might say, you know what, I can't afford this setup that I've got myself into. And so I am willing to take my mortgage to 4% now because I can make my payments $2,000 less a month, and that I can afford. And that makes me feel secure. So, if the person could wait till next year, great, but it's important to have that conversation, look at the options. After all that's done, then I think you take a look at fixed or variable and different lenders and decide, what exact mortgage am I going to take? But I think if you skip over those first couple of steps, you might regret the decision that you've made.
Talk to me about the benefits of talking to someone like you, who is obviously a mortgage expert. Why should someone come and see a mortgage agent?
I think with a mortgage agent, it's about options. I think first and foremost, as I said at the beginning, if it's a reverse mortgage, if it's a home equity line, if it's a private mortgage, if it's a bank mortgage, we have options and we can really compare them side by side so that people can say, yeah, you know what, I think that would feel best for me if I did that particular option. On top of that, once, let's say we decide to do a bank mortgage, if you walk into the bank on your own, you're negotiating your one mortgage. If we're doing it for you, we might do 50 or 100 mortgages with that, let's say, one of the Canadian banks, and we'll probably get better pricing based on the volume of business that we negotiate with a bank, as opposed to you walking in the doors and just saying, well, this is my $500,000 house or mortgage. What's the best rate you'll give me? Because the bank is really interested in getting our, if we're only giving them 50 mortgages, how do we start sending them 100 mortgages? And our answer to them is give our clients better rates.
So I love that bit of information. Now, for somebody who is looking to get advice from a mortgage agent, should they be talking to you earlier when they sort of make the decision that they want to buy a home? What's sort of the timeline there?
I think whenever it's on your mind. I don't think there's so much a set time as if you're a current homeowner and you feel stressed, I think that's the moment. The sooner you act, the sooner you start asking questions and reaching out, the better your options seem to be. When you wait, it doesn't seem to play out near as well, and your options become more limited. Same with purchasing a house. I mean, before you go out and fall in love with a home and make an offer, I think it's important to start with the budget and say, okay, look, this is what I can really afford. This is the life that I want. This is what it looks like financially. And then go out and find the house that fits that. And it may not be the dream home right away. And it might be a stepping stone to getting you there. And it might also be that you open up to this conversation of maybe we should buy with family. Maybe we should buy, siblings together with my parents, like whatever it is, so that the whole plan makes sense and you're really going in the direction you want to go in. Now, on your mortgage renewal, if everything's going great and you have no stress, I would still say 6 months before your renewal, you should reach out to a mortgage professional and have them start, understanding your plan and give you ample time to be able to look at different options and prepare for that renewal so that you can make the most of it, because it generally happens once every 5 years.
So obviously these changes from the government, one of their plans is to help encourage the first-time home buyers to get into the market. Can you talk about some of the incentive programs that are out there for first-time home buyers?
Yeah, I think one of the big things that we've seen is the increase of the home buyers plan, where one can take funds out of their RSP and have it help with buying a house. Now, there's a misconception that people think that is only for down payment. It's there to help you buy a home. So if that is to help you cover your legal fees, if that's to help you, pay off your debt so you can afford a mortgage payment, if that is for upgrades after you buy the house, it doesn't have to go towards down payment, but you do need to be a first-time home buyer and that's purchased a home. And it's a wonderful program. And so you could have two people, if they each had, let's say, $70,000 in their RSPs, which is a lot. But if that is the case, then they could each take $60,000 or $120,000 out of their RSPs and use those funds to help them make it a reality to become a homeowner. And I think that was one of the biggest changes. We still have the what do you call it, the refund or kind of a instant rebate or reduction of land transfer tax. It makes it a lot easier in purchasing your first home. But these recent changes in going to a 30-year amortization, and I'm somewhat hopeful that that isn't the end of it, that there's going to be more positive changes to come. But I think, that is really going to, I did a calculation yesterday, and it was about $100,000 more that somebody could qualify for and this was a family making $200,000, but they could qualify for $100,000 more on a 30-year than a 25-year. If that continues to a 35 and 40-year, they're going to be able to qualify. And I mean, the payment's staying the same. We're just saying how much of a house that can purchase, that you stretch it out over a longer period of time. And that could be a $300,000 increase. And when you start thinking, I could buy a house on my own for $700,000, or I add in mom and dad, we stretch it over a 30-year amortization at this point, and we say, we'll split the mortgage in half. You can start making your whole budget very affordable and really change the direction of your life. But it starts with conversations. It starts with reaching out to somebody and just seeing where things are and coming up with different unique concepts, because it's not the same as it always was before.
Well, I really appreciate all the information that you've given today. Do you have any final thoughts for our viewers?
Final thought, I think there's a lot of people struggling out there. There's a lot of people struggling silently, and they're not talking about it, and they're embarrassed about it. And I want people to know that it's so common, that almost every household is having financial challenges with the increase in living. And to reach out to your friends, to reach out to us, to reach out to a trustee, just talk to somebody, because you'll find options, and everyone's looking to get through this together.
Well, for anyone who wants to connect with you, Cory, online, social media, professionally, how can they do that?
I think the best thing, I have a kind of a non-for-profit yourplan.ca. And if you go to that website, you'll find all my information.
Well, Cory, thank you again so much for taking the time to being here and share your advice with all of our viewers. And I also want to thank you, our viewers, for watching. Until next time, I'm Shannon Jackson.
Connect with us by visiting our website or email us at comments@rogerstv.com.
Summer days, summer nights, lots of things to do, places to go, and people to see. If you're having a few drinks, be sure to plan ahead and get home safely. We don't want to pick you up. Drinking drivers risk injuries to themselves and others and take chances with their license, their jobs, and their future. Remember what's at stake and choose your ride, whether you're the driver, the passenger, or the party host. Thanks for supporting Sober